Good afternoon, everybody. This is Bob Iacino from Path Trading Partners, along with my co-founder, Mike Arnold. This is another in our technical tool series, Technical Indicators as Applied to Cryptocurrencies and the Traditional Markets. And this one is covering one you may have heard of. It's the RSI, which stands for Relative Strength Index. So let's go ahead and get started. The Relative Strength Index. The RSI was developed by J. Wells Wilder and introduced through his 1978 book, New Concepts in Technical Trading Systems, as well as in Commodity Magazine in the June 1978 issue. The RSI is typically classified as a momentum oscillator. It's used to measure the velocity and the magnitude of directional price movements. The RSI indicator can range in values between 0 and 100. Those are the basics. Let me turn it over to Mike to talk about the calculations.
Thank you very much, Bob. All right, RSI calculation. This is a bit complicated, but you should get exposed to it and at least walk through it one time so you know what the indicator is you're putting on the charts, and then you can pretty much forget about the calculation. So the RSI is 100 minus 100 divided by 1 plus the relative strength. That leads to the question, what's the relative strength? Before we get to that, we have to determine how to derive the relative strength, which is derived from the average gain, which is the total gains divided by the n number of periods. So if it was a 14-period indicator, it'd be 14. If it was 5, it'd be 5. You're going to do the same thing for the average losses, the total losses over those periods. And then you're going to calculate the first relative strength, which is the average gain divided by average loss, which gives your first reading. And then all subsequent relative strengths are actually smooth relative strengths, which is the previous average gain times the period you're using minus 1. So if it was a 14 period, it would be times 13, plus the current gain divided by n. And then you're going to do that same thing with the average loss times the 13 plus the current loss, all that divided by 14. That gives you your smooth relative strength, which you can then plug back into the top equation, RSI, and get the RSI, the 100 minus 100 divided by 1 plus relative strength. And I already covered that where the n is the period. So here's a spreadsheet that shows the Ethereum closes, the change from the previous day's close, and then calculates the gains or the losses. And you see if it's a losing day, it will have 0 for the gain. And if it's a up day, it'll have 0 for the loss. Then you do the calculations. So after you get 14 of these, this is using a 14-day RSI, you can work out your average gain and your average loss for the previous 14 days. Plug that in. You'll use the first RS relative strength equation, which is just the average gain divided by average loss, which comes up to 110. You can then get an RSI value. Then you use the second equation to get all the other relative strength ones and plug that into your RSI, and you can see how your RSI varies. So that's just a simple overview of what's going on if you wanted to work it out in a spreadsheet. Now, the default setting for the measurement period is 14. It's pretty much how every charting platform that comes with RSI is set up. It also what J. Wells Wilder recommended. Now, traditionally, his recommendations also were readings over 70 are considered overbought and readings under 30 are considered oversold. So you're going to draw those lines also on the indicator so you can see when the RSI is either over 70 or under 30. However, in practice, many traders have also used the levels of 80 for overbought and 20 for oversold instead of the 70-30. And it really depends on what period you use. If you're going to use longer periods, a lot of times people lower the levels. If you're going to use shorter periods, a lot of times they raise the levels. Here's an example of the RSI. This is on the Ethereum US dollar 60-minute chart. And you can see there's an orange line up at the 70 mark, an orange line on the 30 mark, and you can see how the oscillator moves back and forth between them. Let me turn it back over to Bob to go over some different ways to trade the RSI indicator.
Thank you, Mike. So trading the RSI. There are two major ways to trade the RSI: overbought and oversold reversals and divergences. Both of the setups are used for both bullish and bearish trades. So let's talk about overbought and oversold. Traders utilizing the RSI to trade overbought reversals look for the RSI to get above the key level, which is generally set at about 70 or 80, and then reverse back below that level to initiate a sell or a short trade. Traders utilizing the RSI to trade oversold reversals look for the RSI to get below the key level, which is generally set at 30 or 20, and then reverse back above that level to initiate a buy or a long trade. Please keep in mind the market does not have to reverse. It could merely go into consolidation like any indicator. These things are not 100% green light, red light. They're not just immediately buy and sell signals. They're indicators. They're indications that something could happen. So here we have a chart with what an RSI trader, a pure RSI trader, would consider an overbought short trade. So you have a market that you can see it's kind of got an uptrend to it. And right around here, the market peaks, but not only that, the RSI peaks above what is set here at the 70 level. It spikes up above it and then comes back down below it. You get a red candle, and that would be your signal to sell right about here. And then you could see the market trends down after that. This would be an example of an overbought RSI-driven short trade. The RSI was overbought. An overbought condition can't go on forever. It can go on for a long time, but it can't go on forever. So this particular trader initiates a short trade when you get back below that 70 level. Similar situation, but we have overbought. Actually, the overbought begins here. Here's that 70 level. You've got a market that's trending up pretty strongly. You get above this overbought level, and now it breaks just barely below it, which would be the entry for a short. But you can see instead of collapsing, the market goes sideways. This is what we're talking about. We're saying it isn't just a pure red light, green light. It isn't just, hey, we're overbought, went down below, it's got to go lower. That's not the case. If you think about what overbought means, it basically means that there's been too much aggressive buying. Sideways movement cures that, the same as down movement does. It's not just down movement that stops the aggressive buying. If there were still aggressive buying, it would continue to go higher. Here it went sideways. That's not good for the short trade that was taken when we got below the overbought condition here. But it did cure the overbought condition on the RSI. So that's where you need to be careful. Let's look at an oversold long trade. Here we get down below what is set as the 30 level on the RSI indicator. You get below it, you break above it, that initiates a long trade. Now again, it goes right back below, goes sideways for a little bit, but then turns around and rallies up. This is a successful oversold long trade. By the same token, same way we showed it on the overbought chart, you can go into consolidation after an oversold condition. Here you've got oversold, doesn't get back above it until here. Trader initiates a buy, but then it goes sideways, actually before resuming the downtrend. Now here you can see we get out of the oversold condition on the RSI. But again, aggressive selling causes us to get into oversold. The aggressive selling stops, the market moves sideways, buyers don't come in. So you have to be really careful, again, about using this as just a pure red light, green light situation. Another way to trade them is divergences, and I'm going to turn it over to Mike to go over the RSI divergence style trade.
Thank you, Bob. So another major way that traders trade with the RSI indicator is use it in conjunction with divergence setups. A classic long divergence setup is one where the price action makes a lower low, but the RSI makes a higher low, thereby diverging. A classic short divergence setup is one where the price action makes a higher high, but the RSI makes a lower high, thereby diverging. Some traders want the divergence to occur in the overbought, oversold areas, while others don't care. That's a matter of preference and testing it out for what markets they're following in time frames. Here's a classic long divergence trade. So you see here the market, in this case Ethereum, makes a lower low, and the RSI makes a series of higher lows, finally getting out of the oversold area, and the market reverses. Here's a short divergence trade. So you see Ethereum going up, makes a high, then makes a higher high up by that green arrow. You can see the RSI makes a slightly lower low, and then the market reverses, and the RSI eventually drops out of the overbought condition. So those are the two major types of divergence trades, and we're not going to go into hidden divergences or anything else. This is not a full divergence class, but that's the basic way that RSI can be used with divergences. Other RSI uses. Some traders also combine classic trend lines and horizontal support resistance levels with the RSI. They wait until the RSI breaks a trend line or support resistance line before initiating a trade. This technique can be combined with other entries we already reviewed or as a standalone concept. So here you have a trend line. In this green trend line on the lower RSI chart is connecting some of the lows. And then finally, the RSI breaks the trend line and a trader may look to initiate a short trade with just a broken trend line. They may also wait for it to break below the support on the chart from the price action and use the break of the trend line in conjunction with some price action. There are many different techniques that can be utilized with this kind of trading and drawing classic chart patterns on the RSI indicator. I'm going to turn it back over to Bob to go over some RSI tips.
Thanks, Mike. So we end these videos with tips. So let's end this one with tips. Try many different length RSI settings and test them out with the time frames and markets you follow. Don't just rely on the 14 period default setting. The minute you open up an RSI indicator, there's a high probability it's set at the 14 period default. Many traders have found success using RSI periods of 5 or less with 90-10 or 85-15 overbought, oversold levels. Check the market that you're actually trading in and look back as far as you can find data. Combine price action from the markets with the RSI reversal trades to increase the probability of good entries. As I mentioned and as Mike mentioned, you don't just want to rely on the simple RSI, overbought, oversold, or even divergences. At least divergences, you're including price action in it. That's a better way to trade it. For a short trade, instead of just waiting for the RSI to trigger the trade, also require price action to break a key trend line or support level. For a long trade, instead of just waiting for the RSI to trigger the trade, also require price action to break a key trend line or resistance level. The RSI is a very good indicator for determining when markets are potentially overbought or oversold. You will hear a lot about the RSI if you decide to move into traditional markets. Remember, the RSI can remain overbought or oversold for a very long time when markets are in strong trends. There's an old market saying that a market can remain overdone longer than you can stay liquid. You should keep that in mind. The RSI indicator can be combined with classic price action trading to help a trader fine-tune their entries. Indicators are not standalone entry and exit tools. They're indicators. They indicate something. Thanks for watching, guys. As always, check us out on Twitter at @path_trading. Like us on Facebook and visit us at pathtradingpartners.com. You can find our support email there and check out all the free stuff that's on there. And please listen to our podcast. We enjoy doing it. The Money Path, you can find that on the website as well, along with blog articles and everything else we offer you guys. Cheers, guys. Thanks, Mike. And thank you guys for watching.